Hello everyone and welcome back to the Easy Finance channel. Today we are moving into one of the most important tools in corporate finance and investing, net present value, often shorted to NPV. If you've ever wondered how companies decide whether a project is worth doing, how investors compare different opportunities, or why some investments create wealth while others destroy it, then you're about to learn the central method behind those decisions. Stay with me until the end of the video because I will also give you my best tips for exams and job interviews on how to handle NPV questions quickly and confidently. So, let's get started. The net present value is a method used to determine how much a stream of future cash flows is worth today. But first, why is there a difference in the value of money today and in the future? The answer is simple. You can invest the money now and earn an interest. Inflation is also decreasing the purchasing power of money over time. For these reasons, we discount future cash flows back to their present value so that we can compare them better. Imagine you invest $1,000 today and this money generates 10% interest each year. So we multiply 1000 by 1.1 or 110%. After 1 year, you would have $1,100. If you continue to invest the money, the $1,100 will become $1,210 in 2 years. In the same way, we can now determine the present value of money by simply reversing the formula. Assuming we have $1,210 in year 2, instead of multiplying the value by 1.1, we divide it by 1.1 and get $1,100 for year 1. If we now divide the $1,100 again by 1.1, we have our initial $1,000 back. So the formula for the NPV looks like this. NPV equals the sum of all future cash flows divided by 1 plus R to the power of T minus the initial investment. The R in this example is the required return, and the T is the time period. So at first it looks a little bit difficult, but I will explain everything really in detail to you in the next example. Imagine a project that cost $1,000. The cash inflows over the years are $300 for 4 years at a discount rate of 10%. First, we create a table to visualize the example better. Now we discount each cash flow as we learned before. We take the cash flows from year 1, so $300. We divide it by 1 plus the discount rate, so 1.1 to the power of 1 because we are in year 1. Then we add the 300 divided by 1.1 to the power of 2 because this is the cash inflow for year 2, and we continue to do so with every year. The next step is now that we add them up together. This equals 950.96. Now you see, the NPV of the project is negative, so it means that the project is destroying value. Always memorize, if the NPV is positive, the project adds value and is usually worth doing. If the NPV is negative, the project destroys value and should be avoided. So, if somebody offers us this project, we deny it, because we see it doesn't make us a profit, it destroys value. The two most important inputs to an NPV calculation are the discount rate and the cash flows. The discount rate is often the firm's cost of capital, also called WACC, weighted average cost of capital, or the investor's required return on the investment. Getting the discount rate or cash flows wrong can drastically change the NPV. Now, as promised, here are my top tips for handling NPV problems under pressure. First, always write the full formula before plugging in the numbers. This keeps your work clear and earns partial credits if you make a small arithmetic error. Second, set up a simple timeline. Draw periods 0, 1, 2, 3 and so on, and write the cash flows under each. It helps you to make a structure and prevent mistakes. Third, be consistent. Discount all cash flows to time 0. Fourth, check your signs. Because the initial investment is usually a negative cash flow at time 0, so don't confuse this and add it also, so you have to subtract the initial investment in the end. Fifth, remember sensitivity. A higher discount rate will lower the NPV, and a lower discount rate will increase the NPV. And finally, in interviews, it really impresses recruiters if you mention that the discount rate should normally be the company's weighted average cost of capital, because that shows you understand how theory links to practice. To summarize what we have covered today, net present value calculates the present value of future cash flows minus the initial cost. A positive NPV means value creation, a negative NPV means value destruction. It is one of the most reliable tools for investment decisions and a favorite of finance professionals because it directly tells you how much value you are creating in today's terms. In the next video, we will explore the internal rate of return or IRR and see how it compares to the NPV. If you found this video helpful, please like it, subscribe to the Easy Finance channel, and hit the notification bell so you don't miss the next lesson. Thank you so much for watching, and I will see you in the next video. So, bye bye.